Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. I'm the host, Richard Benuli. Today is Wednesday, November 29th. We have Tom Luongo and Ira Harris. Tom is an Austrian School economist, former research chemist who contributes to Seeking Alpha and Newsmax Media. He's the owner and publisher of the Gold, Goats, and Guns newsletter. And Ira is an independent trader, hedge fund manager, and global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Morning, Richard. Thank you.
Good morning. You can see me, right? Is my camera on? Okay.
Yeah.
All right.
Great. I thought we would begin, Tom, with your macro view on the global economy and the financial markets in general.
That's a good question. The way I've been reading it for a while now is that we are in a breakdown of the previous coordinated central bank policy that was put in place after gold spiked back in 2011 and the U.S. lost its AAA rating, and then they kind of coordinated policy at the zero bound, and then the Fed about 2 years ago now said, you know what, no. And then everybody is now kind of scrambling around trying to figure out how to deal with 5.5% interest rates, and I think everything stems from that. So that's been my fundamental kind of thing for the last couple of years, is to watch the world howl at what it looks like when you come off the zero bound and then aggressively go to 5.5% when the Fed I think needs to do this because of the tremendous amount of insane leverage that was created during the zero bound years when money was basically free, and now money is not free. And as Ira well knows, what leverage giveth on the way up takes away twice as fast on the way down. And that's, I think, where we are today.
Yeah, some good points. Your thoughts, Ira?
Well, this is our jumping off point, so I can't agree more. And we're in the throes of it, as we see, because as we were talking about with gold pushing back up at these levels. Although I'm going to be very cautious about the gold here when we talk about it. I'll say why. Not that I don't see what's going on in the world. I do. And it's not the geopolitical events, by the way, because we saw what gold did at the outbreak of war in Israel, or in Gaza, I should say, but in Israel, that there was some movement, but really not much movement. This is all in regards to central bank policies that we're seeing now. And it's why we've gotten a pretty significant move in the last, 6-7 trading days. I mean, it's been pushing hard. So, but I'm going to be very interested to see what takes place here. But yes, the cost of money and leverage. Chris Whalen put out just a masterful piece the other day where referring to Jerome Powell as a moral hazard. And we talked about that piece. And back in 2002, believe it or not, I tried to get a piece published in the Financial Times and the Wall Street Journal under the headline that Alan Greenspan was a moral hazard. But in those periodicals, they were not going to, but it was a very thoughtful piece because I don't get hysterical and I don't throw bricks just to throw bricks. But it was a statement about the repeal of Glass-Steagall, and that opened up the gates for absolute moral hazard, especially as I argued then, and I'll argue today, and I'll argue forward, regardless of what that asshole Andrew Ross Sorkin would say, because he said Glass-Steagall had nothing to do, of course, with the great financial crisis. But the key to Glass-Steagall was, of course, the FDIC insurance. And most people don't realize that the day that Glass-Steagall was passed, I believe it's 1934, that afternoon, FDIC insurance was approved. So the two went hand in hand. But when they repealed Glass-Steagall, they forgot to repeal FDIC insurance. Or if you opted out of Glass-Steagall, then you had to opt out of FDIC insurance. And of course, No. So of course they privatized the rewards and socialized the risk, which in 1934 they of course did everything they could to prevent that from happening. But that's why I love the piece that Jerome Powell is a moral hazard, because that's in fact where the whole system exists right now.
Yeah, well, I'll just remind everybody that I actually have been quite impressed with Powell. So the way he's handled these last 2 years, trying to come off the zero bound and actually having prepped everything properly. This is not to say in any way, manner, shape, or form that I am an apologist for central bankers. Like, let's in no way, manner, shape, or form get that in our heads, right? No, it's just that if I look at things from Powell's perspective, if I look at it from the commercial banks that he represents, from their perspective, I say to myself, okay, we can have World Economic Forum style public formation of capital and the collapsing of the commercial banks into the central banks, or we can continue the two-tier monetary system where the central banks are the consigliaires for the commercial banks, and at least we have some, market forces driving the private formation of capital. And this is, it's not perfect. It's, Murray Rothbard would be rolling over in his grave. But at the same time, like, Murray would also be very pragmatic about this, going, never let the perfect be the enemy of the good. And this has been the way I've kind of tried to describe a lot of this for the last couple of years. So, 2 years ago, I said, if Powell's going to start, before he even built the $2.5 trillion reverse repo trust fund that he built, slush fund that he built for himself, liquidity fund, basically. I said, look, he's going to have to take, if the Fed's going to survive this at all, he has to take rates somewhere around 6%. He has to normalize interest rates to, historically. Otherwise, the Fed's going to get destroyed. It's literally on a path to its own destruction. And all of the member central banks, all of the big central banks are, as everything then would get rolled up in the IMF, as Jim Rickards has argued for years, which was always the plan. So I find it interesting that, Chris Whalen is writing about that now. And I like Chris, but at times I find him, I don't know. So I find it interesting that he's writing that article now, given that Powell's actually done exactly what he needed to do in order to try and rein in the insanity of the 2010s, of the Bernanke-Yellen era. Like, that's the part I don't, that's the part that I find frustrating about where we are today, that a lot of people just, like, they finally got exactly what they wanted the Fed to do. The Fed did it, and now you're complaining about it.
No, he's not complaining. So let me, because he does, Tom, what you do, and he really points the finger, of course, at Bernanke.
Sure.
Right? Because Bernanke's major flaw, and I would, as long as we're walking down this road.
Cool. To me, I didn't read the article by Chris, so I don't know. I just want to make sure. But I've seen some of Chris's commentary recently, and I was always confused by it. So I'm actually, please explain. Thank you.
He would just say that, and I'm putting words in my mouth. Nobody could say it better than Chris. But in order to do what they did, loading up the banks on QE, that it set them in this path. Chris was the first one to start arguing that, of course, they're going to have to raise rates. There's no question about it. But that is going to reveal that the emperor is naked. And that's right. And he points the finger at Bernanke, because as I've maintained over and over, and I know, Tom, you too, we never went into deflation. Bernanke put in a program in all that he learned about Japan, and of course from the 1930s, that about what to do to head off deflation, but we never went into deflation. Now, people in the mainstream media said, well, that's the counterfactual. Well, if he hadn't done it, and I know, and as I argued with Santelli in real time back in, because Rick was totally opposed to QE1, but I said, you need QE1 because what the 30s taught America is you don't want to get into the system. The political system cannot handle a liquidation, right? What's his name is Andrew Mellon, who was the Secretary of Treasury, who said liquidate the banks, liquidate the landholders, liquidate the debtors, liquidate them. The American system can't take that. So QE1 was necessary. I never understood QE2, QE3, QE4, and then what Powell did during after and Powell tried to do the right thing in 2018. He pivoted.
Yes, he did.
And then, and I'll give him that. But as Druckenmiller, said, and again, Santelli and I talked about it in July of 2018. He needed to do one or the other. And I thought he should have raised Fed funds rate to 2% immediately and held them there, and then started down the path of quantitative tightening. Doing them both and continuing them both, then he panicked himself, as we saw at Christmas of 2018, and then COVID set him on an altogether different path. And if you like QE1, QE2, QE3, you loved 4, 5, and whatever. And yeah, you're right. There's no question, because but to me, his great mistake was they continued doing QE all the way up into March of 2022.
Yeah.
What were you? I mean, if you're raising rates, why are you still doing QE? That boggled my mind.
Well, what's funny about this, Ira, is that I think that Powell made it he tipped his hand as to what he wanted to do in June of 2021 when he raised the reverse repo rate 5 basis points to keep nominal short-term rates in the U.S. from going negative, right?
Right.
So he did that, and in doing so, he raised $2.5 trillion worth of capital, and then go look at what happened that fall in the political fight over Build Back Better, the infrastructure bill, the debt ceiling, the insider trading scandal that Lael Brainerd created in order to get his job. Biden refused to reappoint him, and it was only when the FOMC voted him chair pro tem in February that Biden then allowed the vote, the confirmation vote, and then he starts raising rates immediately in March. I think Powell wanted to raise rates at Jackson Hole in 2021, but politically he was being barred from doing so. I think he's had to survive 6 months of an Obama-style political hit job against him. And the point of shit like COVID, pardon my French, and the CARES Act and all of this was simply to put the Fed in a position where they couldn't do anything other than monetize trillions of dollars worth of debt. And everything you said, Ira, was outstanding. The thing I'm going to say is, in hindsight, QE2, 3, Operation Twist, all that stuff, it was all designed to destroy the U.S.'s balance sheet. That was an operation. That was a vandal operation by a known globalist and former head of the San Francisco Fed, Janet Yellen, who's now our Treasury Secretary. There's a through line here, and that through line is San Francisco versus New York. And what a shock that we had 4 major regional banks blow up from San Francisco, all offshore oligarch banks buying political favors and everything else. Providing 1% loans to Mark Zuckerberg against his Facebook shares, for example, and many others. And in the midst of all that, Powell raised interest rates by 25 basis points again. Yeah. Which was the biggest, Don Corleone moment of all in central bank history. He literally said, yeah, the banks are melting down, but we're still raising by 25 basis points because we've got this. And that's, I think, the moment when the markets finally went, oh, he's not Yellen, Bernanke, or Greenspan. He's not pivoting. He's serious. And it finally dawned on them that it's serious. And I think what we're living through right now, I was just thinking about this morning. I had to record I do a thing on Wednesdays and Sundays for my patrons. And I said, I think where we are now is this moment where the markets are screaming, oh, by the way, you can't go any farther, right? And I think that we have a brewing liquidity crisis in Europe. And that's part of the reason why the euro is strong, why and why the dollar is weak. And there's a couple other things happening there as well. We can get into the bank. I think the Bank of Japan is also a key player in this as well. But I don't want to hog the microphone for too long. These are just ideas to put out there.
Yeah, speaking of Europe and Powell, I think you've written recently on Powell exposing Europe's hidden war in the bond markets. Mm-hmm. Can you elaborate a bit more on that?
Well, I mean, what I think is the key thing here is to understand that during QE 1, 2, 3, Operation Twist, and all the rest of it, the NERP and ZERP years, the goal was to take the offshore Eurodollar system and lever it up to infinity and create and stuff the world with so many fake dollars at zero cost that they had unlimited funding for whatever project they wanted. And at the same time, you're gutting the balance sheet of the United States at the same time. Meanwhile, note what they were doing in Europe, which was austerity at negative rates in order to create the situation where the world would see Europe as a safer bet than the political insanity that we're seeing in the United States, right? This is why we have the Squad. This is why we have all this stuff. All this other stuff that we see on a daily basis is all about creating the idea that the United States is descending into clown world, whereas the insouciant and wise Europeans have everything under control, when that is completely the opposite of reality. When we have target 2 imbalances and Germany that are insane. We've got Germany deindustrializing and like trying to push to a hydrogen economy, which as a former chemist and high energy physicist is like pushing a dead whale up a beach. Okay. And I'm like, yeah, no, we need oil. And so I honestly think that that Lagarde and Powell do not have each other on speed dial anymore. They don't like each other. And Powell's doing everything he can to put the ECB in a box. And we're just dealing with the way I described it yesterday for my patrons. It's like the way Russia's doing the war in Ukraine. It's like, how can we bleed the Ukrainians white by bombing them with artillery and making them think that they can win? Slowly but surely, we just grind out all of their people. And it's disgusting when it comes to war. But in the financial war, it's the same thing. How do you grind out an opponent who has more money than you? And the Eurodollar markets are orders of magnitude bigger than what the Fed controls as a domestic monetary system. You grind it out slowly by taking away their leverage and taking that gearing and reversing that gearing as quickly as you can, which is why I think Powell raised rates as quickly as he did.
Interesting.
And because he's not fighting inflation, it's a commodity cost push inflation we just went through. You don't fight a supply side problem with demand side tools. Like it doesn't make any sense. Inflation is just a cover story. I mean, 65% of the CPI rise over the last year and a half has been gasoline prices, rise and fall. Chart gasoline futures against a 4-month CPI change, and you'll see that they're like since 2019 they've been in lockstep. So we've been the inflation rate has been tied directly to the price of oil for 4 years now. And it hasn't shifted at all. Don't look at it from an annual, don't try and shift it out of phase. Just take up the last 4 months of the CPI rise and chart it versus the futures price of gasoline, and you'll see exactly what I'm talking about. It's crazy. The beta is high on this relationship, but the directional change of both the CPI and gasoline prices are literally a 1-to-1 correlation with a 4-month lag.
And speaking of energy, do you see, Tom, oil prices maybe escalating from geopolitical factors?
It's funny. I know that they want $60 a barrel oil. I know they want to punish the Saudis for getting off the petrodollar. So how do you punish the Saudis? They need $80 a barrel oil to balance the budget. So they want $50 a barrel oil. Yellen told everybody what the price they wanted was just $60 a barrel for Russian crude. They can't get it because OPEC understands that we can pump a couple million barrels less and make $85 a barrel and make more money. So you've got a lot of stuff happening here. And I look at the Brent crude market as I did a podcast with Vince Lanci a couple of months ago. I said that oil is the new gold. It's the one thing that they spend more time manipulating the price of in the futures market in order to manage its price. They've been doing this for over a year now, and I think it goes hand in hand with what's been going on with them using the Strategic Petroleum Reserve to combat oil prices. So I don't know. I'm not sure what Ira sees, but this is what I've been seeing for over a year.
Ira?
No, I 100%. And as long as, because I tried to defend Yellen not too long ago, and Dr. Mark Faber took me to task. We did a podcast about 6 weeks ago, and I said I had respect for Yellen's intelligence for years, and he just ripped on me. But as I say, and I think this is true, I think Janet Yellen is a very, very bright. She's a terrible politician because she's a very uncomfortable liar. She doesn't lie well. and it gets her into severe trouble. I mean, if I hear one more time that these sanctions are effective, I gag. And when the sanctions were put on by Dalip Singh, and he appeared on 60 Minutes to lay them out, and people, and I don't watch, most of the time I don't watch any of that stuff, but people say, oh, Dalip Singh, and I watched him, and I wrote a blog about it and I'm still in it, that Dalip Singh was the new darker version of Robert McNamara, and that's not a compliment, because the arrogance in which it was laid out was typical American arrogance that gets itself in trouble. America gets itself in trouble when it presents itself in a very arrogant fashion. And I thought those sanctions, and I'm a self-interested party. I own Russian equities that we have, but it's inconsequential to me as far as my living existence. But when I watched it, I said, these are going to fail. And they have been a total failure. In fact, last night, Ambrose Evans Pritchard put out a piece talking about how the Russians are not only floating on oil, but they're floating on a sea of money because they're making nothing but money. And of course, who was buying it? China and India were busy buying it and refining it. And that made perfect sense. So how you thought you were going to pull that much oil out of the international market and not run up prices? Yeah, you could go to the Strategic Petroleum Reserve for only so long, which proved right. And then, of course, you better make nice with the Saudis. But then you had the U.S. Under a really questionable regime within the State Department, led by Rob Malley and others, who were very pro-Iranian and pushing. And the Saudis and Iranian, nobody asks this question. So let me put it to you. I mean, because we can't come away from it. If the Saudis fall under the U.S. protection umbrella, which they were from the 40s when the original deal was made with the U.S. and the Saudi kingdom, what is it that the Iranians want? Why are the Saudis so afraid of the Iranians? And to me, it's a question. And every time I pose it to people who should know, and to me, the Iranians.
Ira, it's actually not a hard question to answer. It's the British. It's not that the Saudis and the Iranians hate each other. They actually, they've made nice. Like, they're breaking bread. They've opened up, they've opened up relations again, and MBS and Raisi just had a meeting together. They understand it as business. The problem was for years is that they were trying to get one over on each other, thinking that they could be, again, Arab machismo, whatever you want to call it. Like, someone wanted to be in charge. And, at the end of the day, eventually the Russian gangster Putin walks in and goes, look, why don't you stop fighting and we can all make more money?
Well,
and that's kind of what OPEC Plus has been doing for the last 4 years. Right.
Right. And it was a game changer in 2017. I think it was October 2017. And why nobody made a great big deal out of this, but I certainly did, and I will continue to. When the Saudi king went to Moscow, right?
Yes.
Unheard of.
Yes.
Are you kidding me? The Saudi king going to Moscow? That was, and yet it did take place. But the Saudis fear the Iranians because the Iranians want to reestablish a Islamic caliphate. And the only way to have the caliphate is to control Mecca and Medina. Mm-hmm. And I can look at a map and look to see where Mecca and Medina are located. I look to see where the Houthis are busy. I look to see what's going on in Syria and Lebanon and how this all, because the Saudis fear the Iranians. It used to be under the Shah, they feared them because the Shah wanted to rebuild the Persian Empire, and that meant controlling all the oil. So the United States had to guarantee, even though they got along very well with the Shah, that they would guarantee, because they put the Shah back on power, of course, after 1953 and the terrible CIA overthrow of Mossadegh, which opened up all kinds of bad things in the region. But all these things are going on and going on. So, but nobody asked why were the Saudis, what was on their radar screen that all of a sudden they were trying to, fall under and be assured of the U.S. Defense umbrella, while the U.S. was busy playing nice with the Iranians. So there's so much going on. So everything you talk about, Tom, I can't agree with you more. How it falls out, I don't know. But let's come back to Europe for a minute.
Sure.
Because I think your views on the ECB, and the ECB is very important here. Only because, as you talk about the Target 2 funds, right? And the German hawks, and it's not just the German hawks, it's what we would nicely refer to the Hanseatic Five. And now with the elections in the Netherlands, you've got the right on the move in Austria. And when I talk about the right, I'm not talking about ridiculous. These are people who have some views. Look at the rise of the AfD, and they're back in the saddle in Germany. So there's a lot of things going on. And the fact that the ECB carries 19 nations' debt on its balance sheet, that if this were to really shake, and the question of European debt and the guarantee of sovereign debt, like we saw in 2012, 13, 14, when Greek 10-year interest rates went to 40%.
Right.
When it was uncertain how this was all going to play out, until, Draghi had to say, no taboos and whatever it takes, did those debt levels really start to change? But even French and Italian, all that debt rose. So if you get greater uncertainty in Europe, because as Lagarde talks about, and Lagarde's a terrible economist, but she's a great politician, because she comes out of the role as finance ministry. She was the finance minister in France, and more than that. And her being a professional lawyer, and where was she?
Ran the IMF.
Yeah, she's got all kinds of, and she was put in for that reason. Don't forget, when she ran the IMF, she bailed out Greece at the behest of the German banks. So she knows, and the French banks, because they were both on the hook for boatloads of money. So Europe, but if Europe were to undergo, if those debt markets started to shake, the entire global financial system would start to shake. It's just not a U.S. thing, because the huge amount of debt that exists on the books of the ECB. And I will tell you this, just by happenstance, I was at a symposium in June of 2016, in which the keynote speaker was Jerome Powell. He was not Fed chair yet. He was, and had Trump had any balls, he would have, I think, made Kevin Warsh or Larry Lindsey the Fed chair, and we would have had a totally different Fed, by the way, in my estimation. But he didn't, and he was fair soul, so he got somebody who he thought he would have a greater impact on. That's just my opinion. We can argue it. I don't want to argue it, but I do throw it out there. But Jerome Powell, and I asked Jerome Powell a question in June. It was the Monday after the Brexit vote, so it was. That's when the symposium was at the Chicago Global Initiative, which used to be the Chicago Council on Foreign Affairs, and I asked him the question: who guarantees the ECB balance sheet? And he didn't even have to think about it. He came right back at me and said, they have a printing press.
Yep.
It stays with me, because the response was so quick, he didn't even have to think about it. But as long
because his answer it wasn't the Fed.
That's
the big one, because Lagarde wants it to be the Fed, and she doesn't want to print. And that's why she keeps arguing for global monetary policy to coordinate to combat climate change. And when he went to the Green Seas Summit in early June of 2021, and she started going off and in front of with all the major central bankers, said, we are now going to coordinate monetary policy to fight climate change. And Powell stood up and went, no, I'm not.
Yeah,
I have a dual mandate. And it was like the scene out of Life of Brian. Like, we're all individuals. Yes, we're all individuals. I'm not. And then Powell just and Lagarde shot him daggers. Go watch the video from that.
No, 100% I remember that. I don't even have to. I remember it. And it's so great that because he
It
was
was
not having any of that. That's where
yeah, no, he was
yeah.
absolutely. And I'm like, and then 2 weeks or 10 days later, he raises the reverse repo payout rate 5 basis points above the Fed funds rate, starts to defend the dollar, builds a $2 trillion war chest on the liquidity side of the balance sheet. He's got all the collateral in the world with $5.5 trillion worth of treasuries going, okay, I'm raising rates and I've got both sides of the banking system covered. I've got liquidity, I've got collateral. Your move, Chrissy. And she doesn't have anything. And one of the things to point out to people in this conversation that we're having is that I think I did the math. Something like 85% of the ECB's balance sheet is impaired because 85% of it is interagency debt or sovereign debt. Okay, and it was all bought at negative nominal yields. They're already underwater 30%, which is why Lagarde has been threatened to do yield curve control last summer and has now executed yield curve control at every level across the entire board. She and I'm telling you, Ira, I don't know if you know this or not. I don't know if you follow this or not, but I started breaking down the TIC report by region. Yeah. And so when I took all of the EU centric folks, and that would include like the British Virgin Islands and the Caymans and Bermuda and all, and all of it. And then you break it down by them, Asia Pacific, which is basically Japan and China, and then the rest of the world. You'll note that Asia Pacific has sold something like since Powell started tightening, September of 2021, like $450 billion with the U.S. Treasuries. But guess who's bought over $600 billion? The Eurozone, trying to defend the euro by maintaining credit spreads by buying U.S. Treasuries. So this whole nonsense, trying to sell in their Treasuries and what would happen to? I'm like, they got the ECBs over here buying, and now at some point, I think Japan is going to start buying Treasuries again because they're going to strengthen the yen and they're going to allow the yield curve to rise, which is what they're in the process of doing now. But even so, I want you to think about the unwinding of any euro yen carry trades that would then be the spark or the catalyst for the collapse of the European banking system, because they're already making noise right now that Deutsche Bank's in trouble, UBS is in trouble. Draghi came out and said they need fiscal integration. Lagarde's come out and said they need fiscal integration. Because they know that the whole sovereign debt market is about ready to crumble, because Powell is not going to lower interest rates until he has to. He may not raise from here, right? But he's going to hold rates at this level while he drains the world of euro dollars, the offshore dollar markets, and continues that process. And as long as the political reality in the United States is that we need lower gas prices to get inflation under control, to then tell Powell that it's okay for him the water's fine, he can lower rates again. But Powell's not going to lower rates again. He's going to go, look, baseline effects are what they are. Oil is $80 a barrel. Gasoline prices are going to go back to $2.50, and inflation is going to go back to 6% next year. I can't cut rates.
Tom,
the economy's going to limp along with slightly positive GDP because of all the spending coming out of Washington. And we just saw the Q3 numbers. They were revised up to 5.2% nominal GDP growth in Q3. I don't believe that number. It's nonsense. It's mostly government spending, but it doesn't matter. The headline, the perception is all that matters. Our great friend Jim Sinclair coined the term MOPE, right? Management of Perspective Economics. And that's what they're engaged in. That's what they're doing. And they're trying to move markets based on this. And eventually, it doesn't really, eventually you run out of other people's money to suppress markets in a particular direction, which is why we're seeing the gold price push above $2,000 in the last couple of days.
Yeah, no, especially on that, my argument on the gold has always been, it's about the world's sense of the credibility of central banks in a fiat currency money world. If you're buying it for inflation, you're way late.
Yes.
Things have, and again, it comes to Europe, and Europe is it's such a pivotal point, and we don't discuss it enough. Even when I had the pleasure, I don't know whether you heard it or not, a couple of weeks, how long ago, Richard? 2 weeks ago with Luke Roman.
Yeah.
And Luke has been really good, just as you're talking about. So we've had this, and this debt issue, and U.S. debt, and you bring up the euro yen. It's my favorite trade, because I keep trying to tell people, if you want to look what's going on, Germany's being crushed by the euro yen trade. I mean, we're up at 160. Where were we at this morning? Well, we're down to 160, 190 as we talk, but we've been up to almost 164 in the last 5 trading days. That is, the yen is being given a ride here, and nobody is responding because the G7, which used to be able to speak to this, nobody's even paying attention. Well, if they're paying attention, it's because, and I think that this goes back to Louis Gavay, and I think Louis was really dead right on target on it, and where we talked about that the yen would be weakened, it would be allowed to weaken as the U.S. and others tried to reshore out of China, and Japan would be a recipient of it. And what works better for Japan than a weak yen? Because Japan has lower inflation than everybody. Not that they don't have inflation, but their inflation numbers are still lower than everybody. And they talk about deflation. Japan's been out of deflation for a long time, and I don't care what Kuroda says. I don't care what Ueda said. They've been out of they're going back to the 90s, and they set their policy by chasing a boogeyman that doesn't exist anymore. But as there's a couple articles out today, the Japanese banks are suffering or potentially suffering exactly what Silicon Valley Bank suffered, because they're carrying these hold to maturity, which Chris Whalen has beautifully talked about for a few years, not with Japan, but with the US situation. But it exists in Japan too, because as interest rates go higher in Japan, anybody who owns bonds are sitting on losses. And if you have to sell them, so they're going to have maybe, but not to the extent that exists in the US. And, the difference in Japan, and people always try to create this symmetry between the US and Japan. That's a false symmetry, because JGBs are, well, when the deflation and even in the aughts, when 97% of Japanese debt was owned by Japanese domestic savers, right? And that's, so when you're living through deflation, the best thing that you can be is owning bonds. So they did pretty well. And everybody forgets about the BOJ, and the BOJ, like the Bank of Switzerland, not only they've been buying, they didn't do just QE, they did QQE, quantitative and qualitative easing, meaning the BOJ. So they were busy buying equities, and their equity portfolio, as bad as their bond portfolio is getting hurt, their equity portfolios made boatloads of money. So they're, unlike the Fed, who only bought bonds, they actually, because if the Fed had started buying equities, they would have really met great resistance, I think, in the halls of Congress.
Right. No, I mean, and that's a great point. I forgot about the fact that the BOJ bought equities, and I was on with Francis Hunt about a month ago, and the two of us came with the Widowmaker trade saying it's time to go long Japanese equities, currency hedged Japanese equities. We both said DXJ, the currency hedged ETF, which is accounts for the fluctuations in the yen. I think at some point they're going to have to allow the yen to rise, though, and let interest rates start to run, because otherwise Mrs. Watanabe is going to get a wandering eye, and she's going to start looking at 5.5% on 3-month money on US dollars, and and she's staring at 3% inflation in Japan, and it's becoming a problem. But the Kishida government's in trouble in this from this perspective, and I think Ueda is trying to slowly wean the markets off of the Japan's policy, but they are shifting their policy. They are moving away from yield curve control. They've already, the way I like to put it in previous interviews, I said, think of the global game of central banks as a big game of Texas Hold'em, and Lagarde gets to deal off the bottom of the deck in order to always hit her inside straight draw. The Fed always has aces, but never plays them, like they've got a Doyle Brunson, and the Bank of Japan plays with their whole cards face up for everybody to see. And about 4 or 5 months ago, the Japanese finally turned their whole cards down and started playing the game again. And then in October, when Ueda said, well, the 1% target's not really real anymore, all of a sudden the Bank of Japan started telling everybody, we're going to start playing poker again. And a little uncertainty in Japanese monetary policy is something that we haven't had in 30 years. And no one's ready for it. Like, everybody's conditioned to believe that the Fed's always going to bail out the stock market, and that the Bank of Japan is always going to, tell us exactly what they're going to do. neither of those things are like in evidence anymore. And the imprinting for so many people is they can't get through that shift in policy. And at the end of the day, all of these things, all of these movers, up until Powell at the Fed, was running cover for the ECB, who were always the weak man at the table, because the goal has always been to shift global capital back away from the U.S. sphere back to Europe.
Yeah,
that's always been the goal, folks. That's what globalism is all about. That's what climate change is all about. That's the 800-pound gorilla in the room. And that's why QE2, QE3, QE4, that's why all of this insanity, that's why the Build Back Better bill, that's why Pelosi, that's why they always run these omnibus spending bills, and they always tie all these stupid votes together, because they're trying to like push everything through all at once, a clown show in Washington, as opposed to what Matt Gaetz has been arguing for, single issue spending bills. Hey, let's vote on the debt ceiling increase and the budget separately. Then let's line item out the budget. Let's act like legislators, as opposed to acting like traitors.
And just so on all these trends, Tom, do you overall see the U.S. dollar, Japanese yen cross trade going lower? And
I think the yen is going. I think the Bank of Japan. I have a patron who's been trading Japan for most of his life. So, and I think he's older than I am, and he's like, the short Japan trade is the widowmaker trade. It has destroyed more people who look at their debt to GDP ratio, slide the slider to the right in their Excel spreadsheet and go, Japan has to die. And they just don't understand the Bank of Japan at all. And he's like, they're going to intervene. And when they intervene and they change policy, they're going to move the yen back to 125.
What?
And they're going to let rates rise quickly. And then and they'll do it when the Fed tells them it's okay to do it. That's what I think is going to happen. And maybe I'm wrong. I'd love to hear if I or you don't agree with that. I'd love to hear why. This is important to me.
No, do I not? Tom, I have this. My biggest stock holding right now is Tokyo Mitsubishi Bank. Okay, I look at Japan, I look at the euro yen, and I go, huh, really? And I look, and I just wrote a piece to somebody talking about the euro yen is driving the Germans absolutely crazy, because there's nobody who competes more directly on high end engineered goods than Japan and Germany. So that euro yen is really a problem for the German. And you look at the German auto industry, forget China, forget what's happening in China. But it's like I tell people, if you're shopping for a car in the United States, you can't even think about a German car unless, money doesn't matter to you, but your ability to negotiate. But your ability to negotiate with the yen as weak as it is far better with a Japanese manufacturer. Now, they're manufactured here. I go, slow your roll on that. And with the United States pushing Japan to spend more on defense and build up their defense industry, you watch, Japanese defense industries are going to become direct competitors. This is going to be a redo of everything that they did with Vietnam in the 60s when you muscled up Japan. No, I can't agree with you more. And interestingly, I was listening, there was a YouTube, you can find it, Kuroda, I think it was the day before Halloween, was speaking to a graduate level class at Harvard. Her name is Christina Davies, I think. And I happened to watch it because it was sent to me by somebody who understands Japan, the politics of Japan better than anybody I know. And he actually is one of my offspring. He's really, and he told me, Dad, watch this. So I watched it. And Kuroda says in there, first of all, I hated it because Kuroda just, his arms couldn't get long enough to pat himself on the back for the great job that he did. But he makes mention in there at the end at 120. So when you said 125, I immediately started laughing. Now and I think, like right now, everybody's talking about, well, the bond market is rallying. We're on this great 1 month rally. That's because it's all short covered. The market was so overly short. Mm-hmm. And you look at the basis trade, and I try to explain the basis trade to people. Yeah, it works. But one of the great advantages of basis trade, if you're short the futures and the futures are going down and you own the cash position, you have a variation margin to your benefit. But when that position starts turning on you, you now have to come up with the cash, and you're not getting paid on your cash side of the bond trade. Yep. So it works a lot better when your hedged futures end is going down. So there's a lot of reasons for this bond rally to be taking place. Mm-hmm. And now, as some very bright people have talked about, but this has been one of my favorite trades, the 2-year, which probably will have more effect on the end, because all of a sudden the end's starting to strengthen here as 2-year yields. Let's see, I just ran them. So we're now down to 466 this morning. Mm-hmm. So the yen has some sticking strength. Now, what would really help the Japanese banks and the yen, of course, would be if the JGBs, the famous widow trade. But I agree with you. The market has two very short positions on. One is the 2-year U.S. Treasury, because it's been the easiest place to hedge, because every time the Fed would talk about raising rates, just sell the 2-year, and you can play it there. And everybody's short the yen because they're still equating it to the great carry trade, of the last 3 decades. Mm-hmm. But that's dissipating. And I could see it's dissipating because the Nikkei, outside of some algorithm, doesn't trade as tightly with the yen as it used to be. Like today, the yen was higher and the Nikkei was still higher. They tried to break it last night. So we're starting to see, I love, probably just like you, when algorithmic correlations tend to break down, because the math, the underlying fundamentals, which the algos don't take any view of whatsoever,
right?
They start to slip. Great things and great opportunities start to happen. So yeah, I am agreeing with you. And listen, you can let's go back to Europe for a minute. We're starting to see some changes in the European financials, because I've hated European banks for a long time, but I don't own one American bank because I can't figure out what their balance sheets really look like with what they hold on their books. Because they also would, like the Europeans, and as you talk about, Target 2 is the greatest thing, because there was a lot of sloughing off of those. And we forget that 18 months ago, the world had 18 trillion of negative nominal yield sovereign debt.
And most of it was in Europe.
And most of it was in Europe. And and the bank holds a lot of it. Whereas even German banks, you can look at a Deutsche Bank chart, or my favorite, and I'll tell you why, Commerzbank, which has been a dog for 20 years. But I've watched it, and when I saw Cerebras, who I'm not a great fan of, but you have to respect their ability, certainly as investors. When they own 10% of Commerce, they sold 5% off about 8-9 months ago. But now Commerce has reinstated a dividend, and Commerce is now headed by Jens Wiedmann.
Oh, is he?
Yeah.
Okay. Oh, wow. No, that's big.
And I'll put one more thing in there, because when you see that Ken Griffin, from Citadel, is getting ready to start trading as a market maker in the European debt markets, I go back to a paper that the ECB issued, I believe, in 2017 or 18, that if you wanted to, because Europe, they don't have a bond. The banks, they don't have that type of system where the banks, step up, have to take a. But if they go to that, the Europeans, the ECB said you had to be domiciled in the EU, which was a blow at the Brits, of course. But right. But it does. So I look at that, and I don't tout stocks. We can talk about them in a way that I'll see the global macro. It's like I'm not touting it. If you think that there's something to it, go do the work yourself. Because I'm not telling you where I'm getting in. I'm not telling you where I'm getting out. I just say this is a pretty good idea based on what I'm seeing in the situation develop. And I think the European debt markets are so critical, like you do, to the whole global financial system. And if we go into a debt situation again, like we did in 2012 in Europe, the global system is really fraught to go into a debt deflationary spiral until the central banks figure out what to do. So I happen to agree with you. And it's one of the reasons that Lagarde and others do push the Fed to keep those swap lines open, those dollar swap lines open, because there's a huge amount of dollar debt around the world that needs to be financed. And we also have that standing repo facility, which hasn't been used, but always worth watching.
Just coming up to a time constraint here.
Yeah.
Final question, Tom, your thoughts on where the opportunities are, short, medium, long term, either for trading or investment, and how can our listeners, viewers learn more about your work?
Sure. For me right now, I'm looking at, I think energy is underpriced. I think that we're not done with, I think we have the next round of commodity inflation is coming in 2024. We've had a nice pump and dump in commodities. And I think that's one thing. I think that we are staring at a sovereign debt crisis in Europe at some point, possibly in 2024, because there's too much political risk. And so I think this rally in the euro is overdone, right? And for all the things that Ira talked about, like, basically we had a massive short covering rally. The Fed kind of backed off a little bit, and everybody said, okay, we're going to put some dollars on. We're going to take dollars that we've been hoarding, and we're going to throw them on the table. November, equity markets around the world up 7 to 10%. Bond markets up 70 basis points or down 70 basis points. It was a buy everything month, sell the dollar month. And that kind of month doesn't happen all that often, right? So it may continue into the end of the year, and then coming into Q1, we'll see a new rebalancing of portfolios and strategies and whatnot. And I think we'll get very, very clear signals. And then markets that have been incredibly volatile, like oil, silver, gold, and others, we could see clear signals coming out of them. So you can find my work over at my blog at tomluongo.me. You can follow me on Patreon at patreon.com/gold, goats, and guns. We have a couple of different tiers with and without a newsletter. And then you can follow me on Twitter, where you can find the very worst version of me every day at TFL1728.
Great Twitter site. Great. Thanks. And Ira?
Well, we finally got to cover Europe, and Tom and I could probably go on next week and do another one, because covering the central banks around the globe, not just the Fed. The world gets Fed centric, and I think you got to be very careful with that. There's so much more going on, and I love that you brought up the point with Lagarde and the look she gave Powell when he wasn't having any of that. I remember that well. So we are looking at, and the gold is certainly doing things, and it's doing things with rates, with real yields again. So there's something going on that people are nervous enough about. Now I'm watching the gold here coming into, because we're doing, for all futures traders or people who trade with a lot of leverage, the cost of carry to the gold, because gold pays no interest. And we saw that happen back in late July, the last day of July, when the rollover happened from August, when people were long August gold and they rolled to December, and all of a sudden the forward carry would cost you like $42. And you saw people said, I'm not, and you saw the market correct, as it should be, because you realize how much it costs you to own gold. Most of the time people aren't paying attention. So now we're rolling over today and tomorrow, to the Feb contract. And I believe the premium is about $21. So again, it's the same cost of carry, Let's see if gold corrects, because, and I caution, let's see. I'm not sure, because if it doesn't happen, then I think we'll get to some levels that people have been looking at for quite a while. And I think Tom's points about the commodities, especially if the dollar comes off, and the dollar seems to be coming off, and the equity markets have gotten some lift from it, as Tom has talked about, and everything else. It was a good month, but a lot of this is short covering. Now, it's nothing that the Fed's doing, and we haven't even talked about the concept of fiscal dominance, which I had long discussions with Joseph Wing and Luke Groman. This is very important, but we'll get to that next time. So it's up to you, Richard, to put it together. Yeah. But Tom, thank you for your thoughts in so many ways, and whether people agree or at least these are things you need to think about.
Yeah.
I agree. The one thing I just on the way out the door, just want for tomorrow, for make it simple for people, from a forex perspective. So a cash perspective, just look for a close of 1986 on gold. It'll be the highest monthly closing price in gold's history. XAU versus US. Highest monthly close in 1986.
I'm going to it right now, so hold on.
Yep. I'm using XAU versus USD, Ira.
I'm just using the gold futures.
Yeah, I'm looking at I don't, because I refuse to spend money on a data package, so I still use the free package over at investing.com. So I use the spot price of gold, but the numbers are really close at this point.
Okay,
it's not even close. Actually, the highest monthly close was in April when the Fed got busy, right after the
that's correct.
Valley. So that monthly close was 1999.40 in the futures I'm talking about.
Yeah, but in the equity in the cash market, it was the highest closing price was 1989.65.
Oh, okay. All right.
And so look for a 1990 close. We almost got it last month. They pushed it down in the last 20 minutes of trading down to 1986.
Okay, we'll keep an eye, on that.
Yeah, that was it. That's what I'm watching for tomorrow.
So, Richard, if I can add just one thing, because I didn't. So when we talked about the banks, and the way we look at things, and with the global macro view. So when I talk about Tokyo Mitsubishi and why I like it, but one of the things I left out, because it's one of those things that availed itself back in 2008. Tokyo Mitsubishi owns 23% of Morgan Stanley, because Morgan Stanley had to go begging hat in hand for capital in 2008. Like Goldman went to Buffett.
Yep.
Morgan Stanley went to Tokyo Mitsubishi. So you almost get 23% of Morgan Stanley for free.
Nice. And to a point that Danielle DiMartino Booth made to me a few months ago, the bank term funding program is a clear signal from the Fed that they want the banks to raise capital. They're not getting a bailout this time. Because if the BTFP was cheap enough, the balance would be $2 trillion. And if they were given the money, if they were given a 1-year loan at 0%, no, they get to buy at Fed funds. Yeah. No, this is the clear signal that they want the banks to raise capital. They're not bailing them out this time.
And we didn't even get into the concept of which the Bundesbank has raised in Europe and why Lagarde has problems, because they want to go to zero-based interest on reserves, which will take us back to the Fed only started paying interest on reserves in 2008.
Right. Yes. And it's what sterilized all the QE.
Absolutely. So when they used to yell at Santelli, "Where's your inflation, Rick? Where's your inflation?" Well, the money was being parked at the Fed. It wasn't circulating the system. Right. Well, we'll end there. Sorry, Richard.
Yeah, no, it's okay. We'll set up another follow-up discussion on this.
Yeah,
happy to. I love talking with Ira. I'd be happy to. As a matter of fact, we should have Ira on my podcast. So
okay, okay.
I'll send out an email.
Thank you so much, Tom and Ira. Take care.
Thanks, Richard.
Yeah.
Bye.
Thank you.
Bye.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.